glad you're here with us, and we'll go ahead and get into it. So the first thing you'll see, and I'm going to leave the screen up right now, is the broker communication. We have started out 2022. I've already had my acquisition team meeting with my guys. We have 4 guys on the acquisition side, and really setting the mindset on broker communications. And one thing that I'll stress to them, and I stress to you as you're getting into this business, especially if you want to get into these institutional level and these brokers that are playing at that level, is it's all about relationships. It is, we look back at our 2021 deals that were awarded to us, and the majority of them were off market. So the fully listed deals, we do get those and we do win them sometimes, but the competition is fierce. And you have some people maybe that are over offering, on deals because they may not know how to properly underwrite, and it could be driving up the price, and you may lose a deal based on someone's mistake. So if you're getting off market deals, that weeds the field out to more professional players, but you don't get those deals until you've built relationships with brokers. And one thing that I say to my team is that you must be friendly and be a friend to the brokers, and not be insincere in that. People can see through insincerity. It's a business, and we're there to make money, and we're there to transact. But we all know the kind of people that you can tell immediately they're only in it for the commission check, on the maybe on the broker side, or you really don't care about the person. They're kind of disposable, but you care more about the transaction or the deal. They may do a deal with you, but they're not going to give you the inside track stuff because they don't feel that you are giving them precedence and as a human being, really. So the human side of things is very, very important. Our model, if you've been on these webinars before, our model is big time about reputation. So we want to never say something that we cannot execute on. So a lot of brokers want to push me to put an LOI on a property. Just put an LOI out. Just put an LOI out. We'll figure it out later. And I'm very, very hesitant to do so because I don't ever want to put something out there and then get more detailed financials and then say, sorry, we can't actually get to what we said we could get to, and we've wasted everybody's time. So being respectful of other people's time, having a good reputation, always be honest, upfront, candid, communicate early and often, never deviate. If at all possible. There are some deals that have issues that you may have to change, but building those relationships prior to submitting an LOI are really what's going to set you apart from the rest of the groups. Because before I submit an LOI, usually on the day of submitting an LOI, I am, I'm going to stop share right now because you don't need to see all that for the whole time, but I'm having conversations with the broker. So, and at this point, my team is doing that more than myself, but on the day of, especially, I'm having a phone call, usually towards the end of the day, and I'm wanting to get a feel for where they think everything's coming in at, and if their guidance is still correct. Because when I initially started talking to the broker about this deal, which is where a lot of this communication already starts. So let me back up a minute. So the communication starts with building a relationship. Then when a deal comes out, you have to immediately communicate about that deal specifically. That's building upon the relationship you already have before you had a deal. Now you have the deal. If you wait to communicate until the offering date, then they don't think you're interested. So you would need to immediately begin or start the communication with the broker the day the deal comes out, the day you're aware of it. That's for on-market deals. And then, as quick as possible, assess that deal and provide feedback on the pricing. So they're going to give you pricing guidance on where they think it's going to trade at. And then you're going to do your underwriting based on that and provide feedback as to why you can or cannot hit that target. It's important to provide feedback even when you can't hit the target, because it helps them determine, if they're correct in their BOV or their broker's opinion of value, because they provide the seller with a broker's opinion of value, which provides a low, medium, and high price, and they're guiding typically at the medium price, hoping to go at or above the high strike price. So that'll give them an idea on where they're at. If all the offers are coming in way over they're high strike them, they misvalued the property. So feedback is always key, and having just conversations about it throughout, just keeping that communication going through the deal process and making sure that, they're always, your name is in front of them. They, oh yeah, Brandon with passiveinvesting.com, I'm emailing, I'm calling. They're definitely interested in this deal. So when it comes time for the actual CFO date or call for offers date, they already know. There's no surprise to them when I offer, and they know where I'm going to offer. And then I'm having that communication on the day of, kind of make sure that their initial guidance is still on track. So it's really just a constant communication process. And within that communication process, you're going to want to tour the deal. Sometimes we tour before best and final round. A lot of times we do not. We wait until best and final just to make sure that pricing doesn't run really high, because that's happened in the last quarter of last year and probably will happen in the first quarter of this year, in anticipation of rate hikes in debt. So when the price runs and we're not able to get where it needs to be, I don't need to waste my time touring the property. I may still submit just to kind of give feedback in a market survey, excuse me, for the broker, to give to the seller. But other than that, I don't want to spend time and money going to tour properties that I know I cannot win. And within the last year or so, last quarter, deals were running so far that if we didn't have $10,000 of room per door on the deal from their initial guidance, then we probably wouldn't win the deal. And even then, we still didn't always win the deal. So if you get your initial underwriting done, and that, let's say they're saying it's $250,000 per door, and you're underwriting, your strike price is $250,000 per door, you're probably not going to win that deal. You can go ahead and submit in first round. That way you're staying in front of the broker, you're active, they see you, you're a mover and shaker in the space, but you're not going to win that deal. And you can communicate that to them if you want. But if you're underwriting and your high strike is $265 a door, and they're at $250 a door, then you probably have a good chance. So you want to come in at guidance, rate at $250, and then wait and hold that. Well, I don't want to give away towards the end of it, but I'm going to talk about the strategy of bidding. So the other thing is, so I'm tying a little bit into the underwriting. So the underwriting is crucial, because you have first pass underwriting, which is, you're looking at pro formas, rent analysis. We're looking at the market, making sure that the broker's OM, is in line with what you're seeing in the market, and ask any questions that you can about taxes, insurance, and rent premiums, because a lot of times they'll have the nicest and best rent comps in their OM, and just make sure that before you submit your LOI, that you have all your ducks in a row. You don't have to get in the weeds. That's more for best and final, where you really start to pull levers. That's where, we're really looking at, to tweak the IRR and to get the cash on cash, because now you're getting tighter to your strike price. And there are levers to pull within your underwriting, within your assumptions, that will help you achieve a greater purchase price. So the initial pass, that's our internal team. We're making sure that we've done a rent analysis of the market. We have our basic, expenses in line, our other income, and everything's in line. And then we can submit based on that. And our team submits initial LOIs without what I'm going to call executive approval, or the manager's approval. That comes later after best and final. So they'll submit initial, because a lot of times you'll lose a deal after initial, and we don't want to be having meetings all the time to approve deals that we're not going to win. So once we're in that and we have a good chance to win it, and we're good communication, then we have a phone call with the managing partners and our acquisitions team, and we call that investment committee. And we have an IC memo that outlines the deal as a whole. And then the acquisition team submits that to us as managing partners. We review the deal with them, and we look at the underwriting, and we make recommendations on where to tweak the underwriting. I think that, our cap rate expansion on exit it's okay to be at 40 basis, because it's a new product. or because of the submarkets in Austin, or something along those lines. Or, yeah, it's in Houston, so maybe the vacancy rate needs to be a little bit higher than what you have. And so that gives kind of the managing partners a chance to really get into the deal and make recommendations on levers to pull. And then the acquisition team can give feedback. Well, yeah, we already looked at that, but we think that this is really the right number, whether it be other income. And we're really getting into the weeds. And before that investment committee meeting, the team has already gone to our asset manager and had him vet the deal. They've gone to our property management company and had them vet the deal. So the process is our initial team vets the deal. Then they send it to our in-house asset manager, Brian Bornhorst. He vets the deal, and they usually will have that call with the property manager at the same time. And they'll talk through payroll and sharing maybe a maintenance person from a property we have close by, and we can reduce, the labor burden here. And they've pulled a lot of levers before it even comes to the managing partners, and make sure that they're not missing anything. So we want that quality control check throughout the process to make sure that it's run through everybody that's going to be involved in managing this property. Once we put it under contract, hopefully, to make sure that nobody's surprised by the business plan. We don't want our property manager to be left out of the conversation. We put an LOI in a property, it gets accepted, and then here you go, here's our pro forma budget. Oh, well, we can't really achieve those rents, or that payroll is too low for that market because labor rates are higher, or whatever the case may be. That's why we have that system in place, and that's something that we've built over time and have implemented over time. And then we are constantly working on our processes to make sure that we're minimizing the impact on people's time that don't need to be involved with it at every level, if that makes sense to you. So you have people within the organization that are their best and highest use of their time is not in the weeds on underwriting, vetting deals. That's where the acquisition team and the analysts and the acquisition team shine. The managing partners are more working at new business lines and systems and processes and vision and marketing, working with the marketing team and working on that front. And so they need to stay focused on that, and the acquisition team brings pertinent details so we can make quick decisions. So the whole idea is to streamline that process so it runs through the checks and balances and can very quickly be qualified or disqualified. So there's a lot that goes on, and this again is a process that's been built over time. When we started, it was Dan, Danny, and I, and we were doing everything. We were finding the deals, we were putting together the budget, we were finding the contractors, we were getting supplies and everything. And so as soon as we could, we add people to take those burdens off of us so that we can focus on what we are best at. I have a question here. What is an OM? An OM is an offering memorandum. So that's just the packet that the brokers put together that kind of outlines the deal, where they're coming up with their pricing. They're basing on these rent comps, and this is what you can raise the rents to, and it's this much behind the rental market, et cetera, et cetera, et cetera. So that's basically an OM. Okay, somebody's saying they want me to go over the flow again. So we have our acquisition team, which consists of our director of acquisitions, Eric Fitzgerald, our senior acquisitions associate, Chris Neary. We just added Elijah in Florida. He's going to be a regional in Florida, and we're going to add a regional in Texas. And as we grow more regionals out west in Arizona and such, we have North Carolina, Tennessee, and such. So we have our director, senior, regionals, and then we have our analyst, Ryan. So that's our acquisition team. So they are working on the deal initially. So the broker, we get a deal from a broker, whether fully listed or off market. It goes first to our analyst. The analyst inputs the data into the spreadsheet model and using Red IQ, which is an automated input system. And then they're working on verifying data. Then they're working with their acquisitions lead. The analyst works with their acquisitions lead to vet the underwriting and work on getting all the data on the rent comps, et cetera. So our team vets the deal first. If they see the deal and they put it on paper and it's just not hitting anywhere near what we need to be at, like it's a 3 IRR or something stupid, or, a 3 cash on cash, it's not really we don't want to waste our asset manager's time with that deal, because it's not going to work, or if it's a deal that's too old for us or something, obviously we're not even going to underwrite that deal. So that's the first thing that we do, that we want that to be vetted, because again, we don't want to be using our property management, our third party property management team, FCA. They need to be focused on managing our properties. Now we need their input on assessing a deal, but I don't want to be taking away from their time all the time with every single deal that comes through. So I want my team to vet the deal first, and they're smart and they can do it. And then the next check with the property management team and our asset manager, who's in-house, Brian Bornhorst, he's an employee. They now are verifying the data and making any adjustments that our internal team has put together. So internal team, then property manager and asset manager together, verifying and changing any data. And then it goes to the managing partners. And that's usually after the managing partner review, or the investment committee review is typically after the initial round and before best and final, because that's, again, that ties back to keeping our reputation sound. Before I get real aggressive on a deal and tell people, oh, we're going to win this deal. Let's say we won the deal and we didn't vet it all the way. And then now we have the managing partners review the deal and it doesn't work. And we have to say, oh, sorry, I didn't vet the deal properly, and we actually can't buy it. So now you have to go back to the next in line in the bidding process and give it to them. You have mud on, or egg on your face, mud on your face, whatever, your name is mud, whatever negative connotation you want to put on that. It's not good for your reputation. So making sure that it's vetted all the way up the chain, all the way to the top, before you get aggressive on the deal. Again, initial round, nobody's going to hold your feet to the fire if you offer in the initial round and you didn't win it. But when you get into best and final and there's 5 groups and you're one of 5, you better make sure that you know what you're doing. So that's kind of what leads up to initial round. After the initial round, and I'll go through the questions a little bit towards the end. I've seen a couple and try to deal with those, but I'll deal with them at the end. But after the initial round, that's typically when we'll do a property tour, because again, we don't want to have people flying over the country looking at properties if it hasn't even been vetted from the managers. Now, sometimes that'll happen before the investment committee meeting, because we want to make sure it's vetted in that sense, like the physical asset. And a lot of times we'll include our property manager in that tour to make sure they like the property and like the area and get a feel, because physical boots on the ground touring is very important. There's a nuance to every deal. And there are deals that look really, really good in the OM or online or whatever the case may be. And then you drive to them and you drive around them and you're just like, I just don't like it. It just doesn't feel right. I just don't like, and then there's ones that you're just like, wow, this thing is amazing. We definitely want this deal, based on not just on the looks of it, but we already vetted the underwriting and now it's verified that the property is legit and we want to get it. So the property tour is part of that. That's usually after the initial round, after you've offered that LOI. LOI, again, just being letter of intent. It's non-binding, but you want to include a lot of the details in there. So I'll show you some of that in a minute. And then best and final round. Best and final is really where you're closing the gap. So you eliminated, let's say first round, there were 20, 30 people in the round, and then best and final is the top 5. Might take like the top 6 or 7. Sometimes I've seen up to 10. I don't like that. I like to keep it at 5. And every broker in the history, if there's any brokers on here, you've said it too. Every broker in the history of mankind says, oh, we're not going to do a third round. No, we don't do third rounds. We just want to award this deal by the end of the week. That's a bunch of hooey. It's never, ever happened ever on any deal unless it's a complete off-market deal. And mark my words, there will be a third round. So leave some room for the third round. And if you can, leave the biggest jump for the third round. So your initial LOI is going to be right at guidance. Okay. There was a point in the market last year where stuff was so competitive that we were basically bidding, let's say it was $250 a door was the guidance, and we could write up to $260 a door. we were offering at 255 door, 50% between guidance and our strike to kind of just jump out of the gate. That worked for us on a couple because it just kind of eliminated a lot of the people right away. But as the competition grew and people saw that the prices were running, we didn't do that anymore. And as we started to sell properties and we understood from the sell side how we look at bids, we understood that they see the names that are in the top 5. So initial round, they see who came up, all right, and your name's in it. And then second round, you don't have to be the highest. Your name's still in the round. You want to be, make sure that you are communicating with the broker, make sure you don't drop out in that round, that they don't take it down to like 2 groups and you're not one of those 2 groups. So you got to be aggressive enough to get into the third round. But if you can, save the biggest jump for last. And sometimes that final jump is not in price only, it's also in terms, because a lot of the institutional groups like REITs cannot do hard money or can't do as much. And so a lot of times we'll try to win deals based on terms, and there are groups that'll, they're buying cash out of a fund and they'll put debt on it afterwards, and they'll shorten their due diligence period because they're not worried about a bank, and they can get it closed up and they'll worry about it after the fact. So that can be beneficial if you're able to do that. We don't have that capability now. We raise from contract to close, and we are reliant on debt structure to close the deal. So we typically will write in a 30-30-30 closing. That means 30 days to due diligence, 30 days to close the loan after that, and a 30-day extension. And the reason we put the extension is there is not really because we'll need more time, is because sometimes the lender drags their feet and they didn't get something in time or whatever, and heaven forbid you go past your deadline. We want to have that extension in there, and we have people push back on it. We just tell them, sorry, this is why we have it. I apologize. I have a dry throat. I had COVID last week. Round 2, I had the initial COVID a year ago, and then I guess Omicron or whatever Greek letter we're on right now, last week. So still recovering a little bit from that. Sometimes in that last round, what we'll do is cut down the due diligence period, because I can get my phase 1 title survey and on-site, walking all the units done in 10 days. So, but we'll say 21 DD due diligence, and then a 30-day close and a 30-day extension. If they push back on the 30-day extension, we'll say, okay, we'll do 2 15-day extensions, and then we'll usually put more earnest money down at that point, which really doesn't make any sense to me because it's all goes towards the purchase price anyways. But we've had it be as high as $1 million additional earnest money for an extension. Hard money is a big one. Hard money is usually contingent on phase 1 title survey. And let me go ahead and pull one up for you, and so we can kind of talk through what I am talking about when I say these things and how it looks in the LOI. I think that'll be helpful for you. All right, you should be looking at my passiveinvesting.com LOI. I did redact this one. I'm going to show you actually the model that we use. It has a little more functionality in it, and I'll show you that in a minute. But so basically, here's our letter of intent. This is usually where the broker's listed here. This is where the property, this is the redacted section, is where the property would be listed. The date, obviously, and this is very, par for the course, if you will. This section, I don't really change anything in this section. Actually, you know what? Let me show you one other one that I have. I'm trying to find the right one. That is not it. Give me 1 second. I apologize for the delay. I'm going to put back up this multifamily one. I'm trying to find my Word doc. Here we go. All right. All right. Can just put in the chat. Can you see the Word document I have up now? Just want to make sure. Everybody see that up there? Yes. All right, cool. All right, so this is kind of what I've put in place. This is a template. You can easily set these up through the design tabs. Actually, where is my? Anyways, I'm not going to get into how to build a Word document because I'm sure you can figure that out. But I had the date. You can put in the date there. Make sure that's up to date. The broker's name. I have them all right here, so I can definitely just click on them. It makes it a little bit quicker for me. This is the typical brokers we work with. JBM is one that was not listed here that we work with. And then letter of intent. See, I have the heading there so the people know if somebody's filling out an LOI that hasn't done one before, they know what to put there. So property name, the city, the state abbreviation, and then I have some of the state abbreviations here. Okay. This just makes it easier, and then I convert this to a PDF. I don't want to ever send a Word with all these changeable formats in there. So purchase price, go here. Purchase price spelled out is how I do that initially, and then purchase price numeric, and you can see the headings that I have right there. So again, if I say, hey, I need you to fill this out, and these are the terms, the big ones are what I'm going to point out right here. So purchase price, earnest money, and inspection period are the big ones. So purchase price, that's where you're having the communication with the broker, and you're telling them, and they're telling you what it's going to go for, and you're figuring out what you can pay for it. And then earnest money. So typically in multifamily, this doesn't work this way in storage all the time. It doesn't work this way in car wash either. But it usually works on 2 deposits. And usually the total deposit amount is 2% of the purchase price, and it's divided in half. So 1% at signing of PSA or purchase and sale agreement. So 1% of total purchase price, and then another 1% after due diligence for a total of 2% of the purchase price. That's the typical hard earnest money, structure that you see in a deal. Sometimes you want to get more aggressive on that. I don't really ever see it going lower than that. Sometimes on storage deals, it's 1 deposit and half of it, it just goes hard after DD. You could do that in multifamily, do 2% initial. I don't like to do that because, it's capital sitting there for another 30 days. So we try not to do that. We do it in 2 deposits, and 1% of 2% of a, $100 million deal is significant. So, I don't want that money sitting in a bank account somewhere. There are options with the title companies to invest that for a very small amount of interest. So it's not just sitting there, but it's really, nominal. So that's the basic purchase price there, and earnest money deposit. And you'll see right here, payable into escrow, third-party agent after the agreement is signed, of which, and this is the part that can change, of which $0 will be non-refundable, contingent on updated title. So I'm reading this section right here. Okay, contingent on updated title survey and most recent positive phase 1 environmental test results and seller default. Okay, what that is saying is none of the money is non-refundable. In other words, there's no hard earnest money. Now, if I did want to do that, I would just change this amount to reflect how much I want to be non-refundable. So you see the non-refundable numeric that I just put in right there. So a lot of times it's going to be 50% of the initial. So 50 basis of the purchase price. And so that'll be the hard money. So if I'm putting 500,000 initial earnest money, initial EMD, earnest money deposit, then my hard money may be 250. If you're wanting to get real aggressive, you can say, 500,000 initial EMD, of which 500,000 is hard day 1. But the hard day 1 is not just like not contingent on anything. In that sentence, you'll see of which will be non-refundable, contingent on updated title survey and most recent positive phase 1 environmental test results. And I do need a comma there. So we want to clear title, Alta survey, and phase 1 environmental, because it doesn't matter if they have provided you typically with that information, but if something's fraudulent or misrepresented, or there's a problem with the dirt or the ground or something, or they built onto somebody else's property and you go to buy it, obviously that's a deal breaker. So you don't want to leave those out of the hard money. And that's pretty typical. I don't see anybody not leaving that in there for hard money. Now, a lot of times I want you to waive the hard money as soon as possible by providing an updated title survey in phase one, and then say, okay, you've looked at it. Now that you're under contract, here's the due diligence documents with all this verification. Now, do you agree? And we're good to go. We do agree but it's still contingent on our phase one title survey because we may find something different. So even though they may say the money's hard per the contract, we always leave a clause to say it's not actually hard day one. So, all right. So then you see here, and then another one is seller default. So we've added that to say, let's say we get all the way into it and you don't put seller default and the seller's just like, well, I just don't want to sell it anymore. And the damages clause is only like, 500,000. So, but I got an offer that's offering me $1 million more. So I'm just going to go ahead and drop the contract. But if you don't put that contingent in there, then the hard money is gone, even though they changed their mind, and your damages for them backing out the contract are capped at a certain dollar amount, which may or may not exceed the earnest money. So that's something that you're going to have to talk to your attorney about when you get into the PSA to make sure that your damages clause for breach of contract or falling out of the contract or stepping out of the contract is equal to your earnest money deposit at least. And then you have attorney fees and all the rest of it on top of that. And then you have your second round of earnest money deposit. Again, that's going to be 1% of the total purchase price. That's after the DD period. So after 30 days or whatever you've agreed to. I've seen it as short as 10 days. That's pretty aggressive, but I've seen it, and you have to be aggressive if you want to win deals. So your second earnest money deposit goes in. So the first one goes hard if you haven't put any hard already, or the remainder of it goes hard, the first deposit, and then your second one goes in, and that is hard automatically because you already vetted the property. You've already said everything's good, we're going to buy it. Here's my deposit, 2%. It's all non-refundable at this point. So if I drop the deal, you get that money. And that's why we leave the contingency in there for the extensions, because if we have deals that are, $3 million in total earnest money or greater. And if the lender doesn't do something right and we can't close on the day, and you have a real stickler for a seller, they could take your money. There's going to be some litigation on that. But that's why you want to make sure that you have that extension period. Inspection due diligence period. This is just laying out how long you have. You can see it here, and you can see I have it as a built-in field. So as my team is filling this out, they can see which needs to be filled out. And these are the only things that are being changed, is these ones that are highlighted. So that way you're not having to go and search for what needs to be changed. They pop right out. You put in the pertinent information and you're done. Inspection period is just talking about, any changes in excess of, certain amount. And then you see closing date on or before 30 days after the satisfaction of the inspection period. I'm reading this section right here. One extension you can see here will not exceed 30 days, may be purchased by the purchaser from seller for $50,000 in this case. That's our boilerplate number. That goes up or down as we feel necessary in communicating with the broker. Earnest money deposit to include all exceptions therein and applied towards the closing purchase price. So there's your extension clause, and you can see the closing date, which is 30 days after the satisfaction of the inspection contingency, which is this is the inspection period. So that's referring back to that, then 30 days, and then a 30-day extension. And this talks about title and everything. And then the other thing we have is closing costs. Seller shall also pay any North Carolina or whatever county it's in, applicable county conveyance fees, costs relating to cancellation of seller's existing mortgages, blah, blah, blah. That's all that we're changing in the LOI on a deal by deal basis. So I'm going to stop there. I know there's probably a lot of questions. I'll let you get your questions in. While you're doing that, I want to just show you a land one. It's just a different format because it's talking about different things, and it doesn't work the same way as multifamily. So we have these LOIs here. Storage is going to look very much the same, so I don't need to really show you that one. One thing I do want to show you is something that is very, very important. This is something we put together that we submit with every LOI. So if you have a seller, the broker should know you already. We already went over that. You should already have a relationship. If they don't, then this helps. But really what this is for, it's for the seller. So what we've done here is put together our current portfolio. Some of these have sold since then, and this is actually, we have an updated version. And then, so everything that we have, our team, broker. So this is the important part. Other brokers that give their testimonial. So if you're new in an area, or these sellers may have worked with other people, they're going to call these brokers and ask, and then we go ahead and provide them for it. And so we try to provide as many as possible from as many brokerage firms as possible, so that we pretty much cover our bases. So if this seller has ever transacted with any of these brokers before, they know who these people are, and they say, well, these guys must, they've got good references. And we just provide this with every LOI, initial LOI submission, to make sure it gets with to the seller, so they understand who we are. And there were two brokers working the deal. One broker brought the deal to us, and the other broker brought the deal to another group. The seller said that these two brokers could do that. And so when we provided this deck to the seller, the other broker who did not bring us the deal was on that deck that I just showed you. And so the sellers were like, well, obviously they come from good references because the other broker knows who they are and gave them a reference. And we were able to use that because that information got back to us. We were able to ascertain who the other broker was and try to gain as much information as possible about the deal process. And that was a very, very competitive bid process, and we ended up winning it. But it was due to this deck sheet right here. So save your references. Sellers, we only have one seller on there now. They're harder to get references, Jason, we've purchased from before. But if you can get sellers, big names, Pasco and Cortland and whoever not that you've bought from, and they can give you good references, that really helps your LOI make sense. So these are all things that we have done to kind of set ourselves ahead and pass the group. So I said I was going to shut up and answer some questions, so I'm going to actually do that now. Let's stop share here. And so I'm going to kind of read these quietly before I do them out loud, just to make sure they're applicable. I'm reading from the Q&A box first, and then I'll go through the chat. Are the acquisition team members paid as W-2 employees, or do they have a part in the investment? So our structure is they are employees. We do have a bonus program in place as well, but and a lot of our employees invest in our deals, but it's not a part of their day-to-day. They understand the benefit of investing in the deal, and so they do that at their desire. Let's see. Got that. Already answered that one. Somebody's asking, can we get a copy of the templates? I will send the template for the multifamily one, and I'll just pull our logo out and make sure there's no proprietary information in there. I think the only other thing is our attorneys in there, so I'll pull that out. And I'll send it to our team, and then I think they can send that out with the recording. I'll follow up on that. I don't have an issue with giving that to you. So let's go ahead and do that. Just make a note. First EMD is hard too. I think I answered the EMD question. If you still have a question about the EMD or hard money, go ahead and put that in the Q&A box. Okay, I see it. Sorry. Yeah, the Word document. Yeah, I have this as a Word document, and then I just convert it to PDF and leave the template as it is. And so I never save the template. I fill it out, convert to save it as a PDF, and then don't save the template, if that makes sense. I have a question about, partnering on outside deals if they're brought to your team. I'm not too sure of what exactly that means. I'll buy any deal that's for sale. If you have access to the seller. So we do not partner on deals that we are not the operator on. If that may be answering the question. So we don't partner. And so say you have a deal and you don't have enough equity, but we bring something to the table, and do you want us to partner and be the loan guarantor? We don't do that. We own the deal outright, and we don't mind paying somebody a fee, if they bring us a deal that we close on. But as far as that, we don't. There's no nothing meant towards anybody else, but it's a protection of a reputation is what that is. The deck, we don't give that out. But basically all it's doing is listing the portfolio, what we've sold if we've gone full cycle on deals, and then references. Our team, you want to make yourself look as big as possible. So think about, an animal, if they're getting into a fight, they puff up and they make themselves look as big as possible. You want to make yourself look as professional and as big as possible on these decks. So that's the intent. And I think that most anybody can do that, or hire a VA to put something like that together. If you don't have any deals that you've purchased, or that's where purchased or sold, then getting with somebody who and being like a co-GP on a deal, and you're not the main sponsor, and getting that track record that you can put on a deck like that, I think is important. So try to build your experience level as much as possible. Let's see here. Yeah, the replay Rose will come out. It takes a little bit of time, but you will get an email if you're registered for the webinar. How much do you believe the numbers on the OM provided? I don't know. I mean, the OM is really just, we use the OM for information to put out to our investors, really, because it's already structured. So we gather a lot of the information, but we have to do our own research. I can look and see where they're coming up with their numbers, but I'm going to do my own regardless. So, it's nice that they get it, but we buy lots of deals with no OM, and our marketing team loves that when we do that, right? So, where do you get the earnest money of syndicating? Also, any attorney referrals. So attorney referrals, we use Brownlee, Whitlow, and Prate out of North Carolina. I think they just moved into Georgia, I want to say. But North Carolina, they're really good. So Norm is our point of contact there. Only Norm kind of works on our stuff, but Brownlee, Whitlow, Prate. And then earnest money comes from the managing partners. So that does not come from syndicate, the investor money, because that's what we call at-risk capital. And so that's a call that the three of us have together and say, we're going to need to put $2 million hard on this deal day one. And that's why we want to make sure all the underwriting is vetted and then we haven't missed anything. And all three of us are on that call to make sure nobody can say, well, I wasn't on that call and I wouldn't have put the hard money up, and we all agreed to put the money up. And so if the deal goes south and we lose that money, it's our money and we all agreed to it. And so that's the conversation that always the three of us have. So that's where that money comes from. And that has to grow over time. Obviously, we couldn't do that day one. And every time you put hard money down, it's a little bit of we call it a little butt pucker moment. So for new syndicators, what is the best way to get funds for hard money? There are people that will do what they call hard money loans, different than what we do on the rehab wallet side, but it's basically putting up the hard money So they're going to want to look at the deal and the viability of the deal, and they will front that money for you, or the earnest money, making it non-refundable and borrowing that money is probably not going to work real well. But initial earnest money you could probably get from a lender. There are people that do that, or some of the key principals that you pay a fee to. In other words, they're the loan guarantor. They have the net worth and liquidity required to get the debt. Sometimes they will provide that too, also for a fee. Virginia, somebody's asking about investing in Virginia. Just there's nothing really that really strikes me as super attractive in Virginia, because Virginia is kind of like on the border of where and we start to get further north, you start to see landlord laws become less attractive. I'm not saying Virginia is that way, but sometimes it is. And a little less friendly towards renters. And there are some good properties in Virginia. I'm not going to say that you should invest in Virginia. We just haven't listed it as a target market, if that makes sense. But we are targeting some secondary and maybe what some people call tertiary markets within our target states, to kind of get around some of the institutional competition where the big Blackstones are looking. So we do look there, but never opposed to getting something in Virginia. Somebody's trying to learn for mentorship. There's a lot of good mentors out there for getting started in the space. We don't do mentorship. We don't do coaching programs, but what we do is provide that information for free. I understand the benefit of kind of like having a mentor, so you can just call them up and say, what would you do in this situation? I get that. I'm not going to recommend anybody specifically, but there are a lot of them out there. And so find a mentor that's in the space that you want to play in. So if you want to be institutional, then find a mentor that's in that space. If you want to be mom and pop in kind of like the small tertiary markets, then find somebody that's in that space. So that's my advice there. Best practices in communication to brokers for them to send deals for those with little to no track record. Just meet with the broker. Again, try to make yourself look as professional as possible. Talk the talk, walk the walk. Give them only the information they need. Just be like, oh yeah, I've never done a deal before. Yeah, I'm just getting started. Hopefully one day. Don't give them that information. Like, oh yeah, what's the IRR here, and what's the cash on cash, and what are you looking at for the taxes, and try to put the questions on them and try to deflect any questions about inexperience away from yourself. So learn to listen and answer with questions is a good way. You can deflect a lot of that. Never be dishonest. Obviously, I'm not advocating that. I'm advocating using the conversation to your benefit. That's something that I learned back when I first started insurance adjusting. I was doing auto claims, and I, going to these body shops. These guys have been working in these body shops for years and years, and some of these body shops are notorious for being, deceitful in their practices. In other words, oh yeah, we got to do this, and we got to do this, we got to do this, and here I am, very new and green, and I'm trying to not let them know that I'm new and green, but still trying to figure out what the process is. So I let them talk, and I listen, and I save some of my questions. I do research on my own to come up with the answers to some of the things they were saying, or to verify some of the things that they were saying. So you can do that in any field that you are not 100% comfortable in. Don't let on that you don't know what you're doing. Are you still doing preferred returns with the compressed cap rates? Yes, we're still doing preferred returns. We always do preferred returns. I think there might be some confusion there with preferred returns and cash on cash returns or monthly distributions, because then with compressed cap rates, your cash is tighter, obviously. And so preferred returns just means that your return is preferred. So even if I can't pay you your return over the whole of the period when we sell the property, your preferred return is going to be paid first, and then the GP splits will occur and the LP splits will occur. That's what preferred means. And so the the distributions, the cash distributions monthly. Yeah. I'm not going to buy properties that are not able to pay distributions on a monthly basis. And they don't all produce 7% year one, especially if it's a pre-stabilized new construction deal, because I'm 70% occupied at takeover and it's going to take me a while to stabilize it. But we project that to the investor and say first year's 5% average, second year 7%, and just do it that way. But there may come a point in time where we have to adjust the cash on cash returns, but we have not done that yet. I say you do purchase deals, seller in Texas. If somebody has a deal and you have access to the seller, it has to be in our criteria. So we are kind of upper B class, A class deals. Our sweet spot is 65 million. We've gone over 100 million. We don't like to go below 20 million, 30 million. It's just really not worth our time. We do sometimes, but it has to be a prior relationship in order for that to happen. Do I invest in North Carolina? Absolutely. We sold 2 in Raleigh this year. We have some in Charlotte. We're trying to buy some more in Charlotte and Raleigh. Wilmington, we have some in Wilmington. That's that. But that's all the questions that I can answer, because we have we have the Storage Investor Nation right after this, and that's in 2 minutes. Sorry. So thank you for all the questions. If I didn't get to your question, email me at brandon@passiveinvesting.com. That'll be in the chat, brandon@passiveinvesting.com, and just go ahead and send me any questions that you have. And then be sure to join us next week. Dan will be here. He's going to talk about finding partners for your apartment syndication team. So that will apply to some of the questions here. But in the meantime, have a great week. Be sure to email me if you have any questions, and thanks for joining us.